Hey, Mark, you know me, I like things that rhyme. So I was really into talking about sell in May and go away, which is, of course, about the typical historical underperformance of stocks in the summer months. But the question is, what if we had just pulled out of this market in May?
So historically, it sounds good, and it did work many years ago, just looking at the data. But over the last 20 years, it hasn't worked as well. And that's because markets have kind of adjusted to that sell in May and go away kind of concept. Anytime you find an edge in the market, usually by the time you find it, start to implement it, it goes away. Everyone else has found it as well. So this might be one of those situations. And this year, if you sold in May, you missed a lot that's happened, and the markets continued to move higher. And in addition, if you get out of the market, you don't achieve or receive the dividends that the markets are kicking off, which sometimes people miss, that it's not just price performance that really adds to your overall wealth accumulation, but a lot of it has to do with the dividends that you're receiving. And dividends are straight cash flow from the corporations coming. So staying investing, you get those dividends, you can either reinvest them or you could spend them if you're getting that cash flow for yourself.
Okay. Let's touch quickly on the history of the saying, which was sell in May, go away, come back on St. Leger's Day, which was essentially marked when stockbrokers a long, long time ago were basically taking off the summer months.
Sure. And so when you're looking at historical data, and this is true for a lot of historical data in the market, there's really almost a pre-era scenario where you go pre-1990, maybe even pre-1980. And there's a lot of these great sayings that whether they came up in the 40s, 50s, 60s, or 70s, a lot of it was skewed by what happened in the 30s. And so some of those big drops that happened in October or even in September, those were really showing up and skewing the data. But as the markets matured and got much larger, much broader participation, you may forget or may not, and not everyone's sensitive to it. The markets were really just owned by a few families, few corporations. It was a very small kind of participation in the markets. It really wasn't until the 1980s that it started to proliferate and go out and hit the middle class. So stocks were really a small caveat or their stock owners were really a small group at that time.
Okay. And now, like you said, take a look back at history. Let's take a look at August and September. We touched on this in another one of our videos, Mark, but explain what we're looking at here, please.
Oh, sure. That just looks at monthly performance historically. And it does break it down past 10 years and post-election, which is interesting. So we're post-election, that's in the gray bar. Past 10 years is in the orange. So it does show some weakness in August and particularly in September. So we would respect the seasonal factors, but we wouldn't fear them. So it's really important to kind of make that distinction. Be aware of what type of market you're in. And that historically, there's just been signs of maybe there's low volumes. And as you mentioned previously, while maybe they took longer vacations back then, this is still the vacation season in August. So sometimes you see light volumes and it spills over a little bit into September. And sometimes there's some funding needs, whether it's the government funding where they're issuing more debt. So you have to raise capital or sell some stock to buy some bonds. That's just how the system ends up working, but it doesn't work all the time. On balance, you're positive through these holding through these months.
Respect, but don't fear. I like that. Kind of want it on a t-shirt now.
Yeah.
Good life advice. All right, Mark, thank you.
Great. Thanks, Erin.